Thank you for staying with us. We now return to our exclusive interview with Managing Director and Group CEO of Acuity Partners, Ray Abeyewardena. We've been seeing a low interest regime now for some time. Now, how is this relatively low interest rate regime actually affecting the market vis-a-vis investment opportunities available for the regular citizen?
We have seen the interest rates going up the last couple of in terms of last couple of months, in terms of what the banks and the deposit-taking financial institutions have been offering. We see we've seen a marginal increase, not significant enough to warrant people having to move their funds from FIs from equities to FIs. So I see that the money will remain, because as of now the interest rates still are at a low ebb. The other side of the coin is that if interest rates do move up, whilst on one hand it offers an alternate investment opportunity or a product, it also makes it the borrowing for those who invest in the market or through margin trading and other borrowed or through debt, makes it costlier to borrow. So you have to bring in the cost of funds, you have to add that high cost of funds into your capital gain to make money. So on a low interest regime, there is a dual benefit to the equity market.
Acuity's post-budget analysis on the fiscal budget of 2012 was, quote, widely hailed for its pro-growth stance, unquote, and also for fiscal consolidation. Can you elaborate a little bit on how you came to this conclusion?
We were very heartened with the 2011 budget. I think it was hailed widely and sort of, I think, unanimously as a very investor-friendly, with pro-economic development sort of mandates in mind. There were tax benefits, tax concessions to corporates, to individuals. So what we saw in 2012 was that same growth momentum, the tax concessions, the benefits being continued. And there is consistency, which is very heartening. The other factor is that I think industries such as manufacturing, plantations, healthcare, pharmaceuticals, there are benefits given. I think there were concessions on to the R&D and the research and development area as well. There is a positive side of the depreciation of the rupee as well, because that helps exporters. Consolidation aside, Savitri, as I said, that it's a fact that there is continuity in what was set out. There was nothing sort of contrary to what they listing in the preceding year's budget. So that's a good sign. Tax concessions, benefits, investment friendly budget. And on the budget deficit as a percentage to GDP, although they had earlier estimated to be 6.8, at 7%, it's very heartening. We're very happy to see that, and that shows that, I mean, the preceding 2 years, I think it was about 9 and 8 times as a 8%, 9% and 8% as a percentage to GDP. That's debt. So that shows that whilst government expenditure has increased, income revenue also has increased. So overall, we were very positive about the budget.
So Ray, where do you stand on this very hotly debated issue of market manipulation and insider trading?
On the point of market manipulation, Savitri, I have always had a view that if one had short selling, this will be able to contra the manipulation, if there is manipulation. Now the market has been in existence, as you said, for a long time, and we have been talking about introducing other instruments to the market for a long time, well over a decade. Short selling itself causes two deterrents to manipulators. One is the very existence of short selling is a deterrent. The other is, if you see a stock going to unrealistic levels, all you have to do is, what the other person needs to do is to short. So thereby market price discovery is driven by market forces, not by control mechanisms that are brought in by regulators to bar stocks or to have cooling off periods and so on. So that my personal thinking is that introducing short selling in some form is an excellent idea. It's a good mechanism to contra manipulation. On the point of insider trading, of course, I guess if you do the crime, you deserve the time.
Is this symptomatic of a developing market, or does it happen at any given time depending on the circumstances?
Market manipulation need not necessarily be confined to a growing market. Because you get market manipulation. Of course, the ability to manipulate a market is so much, the ability is greater in a market which is sort of booming and soaring. I mean, you can't, it's difficult to manipulate a market in a market as we experience it today in the bourse. But the ability is greater in the smaller illiquid market, because where liquidity and free float is limited, it's always easier to take the market up. But I think from a regulatory framework, I think there's a good regulatory framework. Our market is governed by a good set of rules and regulations.
So do you think the cowboys exist here?
I wouldn't call anybody a cowboy, actually. I guess you and I are equally, I am constrained because I'm in the broking industry, but you're free to use your wealth as you perceive it. And if you invest, if you buy large quantities and others decide to follow, that's their prerogative. You can't tell people, I'm buying, so please don't buy. And if there are people who buy and the others decide to follow and the prices go up and they sell, I wouldn't call that manipulation.
So what about the IPOs? What does that do to our market? Is it sort of widening the net of investors and bringing in more numbers?
What happened there again, Savitri, was that there was a lull. There was a virtual shutout of the IPO market, barring one or two, for a long period of time. So no sooner the war ended, what we saw was that there were a whole string of IPOs, and the market rolled out 2011, I believe. And market, we had a huge run on IPOs. So there was a notion or a perception that probably the number of IPOs suddenly coming out at, overlapping at some times. We ran one, somebody else had another one soon after that. So that congested the whole flow and also had a constraint on the liquidity in terms of people's investable income, which is true. But at that time, you have to look at the circumstances and the situation. At that time, where everybody was keen to come. Valuations were good. This was being portrayed as an alternate manner to raise funds than going into the banks. So I think we got some good family-owned, which were hitherto very, sort of very conservatively locked up these things coming into the market. So good things also happen. One needs to look at the positive elements of this whole IPO thing as well. But going forward, I think it will slow down a bit until markets recover.
That was Rhea Abeyewardene. The Voice of Business is up next, and Shaheen Khada analyzes the LMD Nielsen BCI data. Don't go away. Welcome back. As we said in our top story, the LMD Nielsen Biz Confidence Index showed little movement in January, as corporate Sri Lanka appeared to be not too impressed with the goings-on in our neck of the woods. Benchmark's Anushan Selvaraja gets to the heart of the matter.
Welcome to the Voice of Business. Joining me on the show this week is Shaheen Khada, the Managing Director of the Nielsen Company. Now, Shaheen, LMD's February edition quotes you as saying that the index is flat, and that while the decline since August last year has flattened in December and January, the January 2012 level is well below the 2011 peak of 173 recorded in August 2011. Yeah. What sensitivities have led to this?
I think by and large, we see that after the pre-acquisition of underperforming assets bill has been passed in Parliament, we see pessimism increasing quite significantly. The people who think that investment climate is not good, the percentage in January was 25%, compared to 21% in December, 11% in November, and 8% in October. So you can see a dramatic increase in pessimism after the bill was passed. Secondly, I think the global recession also cannot be discounted. Even global recessionary concerns would impact on business confidence.
Despite 62% being in a positive frame of mind a year ago, only a slim margin of 53% say that the economy will improve in the next 12 months. What do you see as the prime reasons for this dip in confidence?
Ironically, Anushan, the business sector expect their businesses to perform well in the next 3 months, in the next 12 months and so on. However, they are pessimistic somewhat about the economy. This pessimism is, I think, basically due to the concerns of the global state of affairs, as well as the trade gap, the balance of trade gap increasing. I believe that also concerns about the tea market have had an impact. For example, the Arab Spring has had an impact on our sales to Middle East markets, and now with Iran also being a concern for exporters, these all would contribute to lowering of business confidence. This would also impact foreign direct investment to a large extent, because with global concerns and the investment in Sri Lanka would come down. However, and the government needs to focus on FDIs. We see that 30% of the population is in agriculture, and for the country to move into middle income status, I believe that more people should move away from low paying agriculture jobs to relatively higher paying industrial jobs. So for this to happen, there has to be FDIs that take place.
Now, an executive attached to a BOI approved construction company said to one of Nielsen's pollsters that, and I quote, "We are concerned about FDIs as it has not been as good as expected," unquote. Now, there is still a majority of 75% according to the poll who believe otherwise, but this is in contrast to the massive 92% poll last year who are upbeat about our investment prospects. Now, what do you make of this, Shaheen? Are people being more realistic these days? Has the post-war honeymoon come to an end, so to speak?
Yeah, Anushan, as I mentioned earlier, 25% are pessimistic about the current investment climate. So we really need to see a growth in the stock market, in FDIs and exports, I guess, for optimism to return, optimism about the economy. The other thing that we need to be careful about is the Iranian situation. I mean, if there are restrictions on purchasing Iranian crude oil, and then we need to source from other markets, the high sulfur crude, then this could have a higher price impact on us. So we need to, which would again impact business confidence. We seem to be at crossroads right now, so we need to watch and see.
Another businessman says that the government has not taken sufficient measures to protect local industry, and that there was nothing in the budget to make amends for this. What is your take on this?
Yeah, I mean, at what cost does one protect local industry? I mean, if tariffs and non-tariff barriers push up import prices to unrealistic levels, we would all suffer a lowering of living standards. But I guess in situations where local manufacturing can produce high quality products at a reasonable price, then there is some justification in encouraging those industries. But this is a double-edged sword. One must always be careful that we don't upset our trading partners too much, because there can be retaliatory action put in by various foreign governments that buy our goods if we don't if we put in restrictions on imports of goods from those particular countries.
The Nielsen Company's Shaheen Khader there speaking to Benchmark's Anushan Selvaraja. That's all we have time for. Do join us again next week on Benchmark.